When it comes to investing, a lot of people can think it as a very daunting task, very confusing, very complex, and you need a lot of money to get started. Well, the good news is you don't need a lot of money to get started. With as little as 50 bucks, you can start doing this. In today's video, we're going to be breaking down 8 ways to start investing with less than $1,000. So really anyone can use this. So let's go ahead and get into this. The first one, opening a high yield savings account. Now, me personally, my high yield savings account is at M1 Finance. We have a link right down below, but it is paying 4%, which is significantly higher than the market average right now. When you look at a high yield savings account, unlike traditional savings account, they have a much higher interest rate, allowing your money to grow more efficiently. If you're sitting in traditional savings account, you're looking at a 0.15, maybe a 0.3, which is crazy. If you're putting your money and if you're leaving your money in those savings accounts, you're losing money because of inflation. If you know inflation has been running about 3 to 5%, if you're not earning or at least hedging your bet, the money you're keeping in those savings account is going to essentially lose money. This is why when we think about our emergency fund, keeping that money in a high yield savings account does make a big difference and really a good starting point. When you start saving that $50, $100, $500, that is the point you want to start really continuing to add funds into those high yield savings accounts, allowing it to grow while it's a little bit invested and getting a little bit of return. Second one we look at, which is my personal favorite, investing into exchange traded funds or ETFs. Now, when it comes to ETFs, it is super easy to invest in something like the S&P 500. Finding an ETF that tracks an index, again, makes it super easy. So an ETF, you might ask yourself, what exactly is it? It is a collection of stocks or bonds that are traded like individual stocks. It makes it easy. And with a lot of these, you can actually have a very diverse portfolio with just one single purchase, and you don't even have to buy it at the full market value. Let's say the ETF is $500. You can actually buy fractional shares, which is awesome, giving you really aligning with those investment goals, but building that risk tolerance, also giving instant diversification instead of having to buy a ton of different companies. When we think of the S&P 500, which is made of over 500 companies and the largest companies within the United States, you're not going to have a portfolio of 500 plus companies. Now, the reason for this is within those 500 companies, you have some really big winners, you have some really big losers, but net, the really big winners do make up a majority of it. And if you have some companies that are doing exceptionally well, thinking of Alphabet, Meta, thinking of Nvidia, those companies actually have the ability to carry a lot of the ETFs and a lot of the market itself, even if some of the companies are really down for an incredible amount of time. Now, third one we look at, considering robo-advisors. Now, this, of course, is kind of the next generation, what we're seeing, combining the ability to have robo-advisors in conjunction with artificial intelligence. When you start asking and answering questions about your financial goals, your risk tolerance, the robo-advisor can really set you up with a portfolio. Literally, the only thing you have to do at this point is put money in there. That's it. Some of these robo-advisors, 50 bucks, 100 bucks, they automatically rebalance the portfolio you build. It tax offices. The robo-advisors can even automatically rebalance your portfolio, tax loss harvesting strategies. They can really have a lot of efficiency over time. And when we start thinking about investing, number 4, we get to buying fractional shares. This is something we talked about just a minute ago. Fractional shares allow you to invest and buy a small portion of a stock instead of having to own the entire share. This option makes it very inexpensive for people to get into very established companies without having to buy in on whatever the price is. If you think of some of these that are super expensive, I'm talking tens of thousands of dollars for some of these shares, you can get in there with the fractional investing. This means you can invest in your favorite companies or even companies that you do use on a regular basis, or getting ETFs as little as $1 single. That's right, to buy those fractional shares. You can diversify your portfolio, take advantage of potential growth, and of course, putting money away to build that nest egg. The fifth one we're looking at is the IRA option. So if you're looking for long-term investing, considering a traditional IRA or Roth IRA has very big tax advantages over time. Now, the traditional version, you do get a tax break as it sits today. For the Roth version, which I highly recommend, you pay the taxes upfront today for the long-term growth, meaning that if your portfolio doubles, triples in the next 20 or 30 years, guess what? In a Roth IRA, that money is going to be completely tax-free during retirement, which is exactly what you want. You don't want to make contributions and then have a lot of growth. have to pay taxes on those growth in the traditional option. Now, many financial institutions have a lot of low cost options when it comes to IRAs, even putting very minimal money in there, even less than $100. Now, something to remember when it comes to IRA accounts, they have to be and need to be invested in the market. I really stress this. I have a lot of individuals on a financial aspect that put money into IRA accounts that are earning a 0.3% in a regular traditional IRA or a Roth variation. And guess what? It's not growing every single time they're putting money into the IRA account because it's not invested in stocks, in bonds, in ETFs. It is losing money in the entirety. And again, like we said earlier, if you want to set this up with M1 Finance, there's a link down below. You can do both traditional and the Roth IRA. Now, number 6, we get into the peer-to-peer lending. Now, this one, of course, peer-to-peer lending are for individuals that traditionally cannot get financing through financial institutions. This is kind of taking your hard-earned money, lending it out to another person for as little as $25 to spread your investment across a bunch of different loans. So thinking about this, if I had $100 and I do 4 loans with $25 each, and it's part of kind of a crowdsourcing or crowdfunding, they take a bunch of money together. Let's say they get, a couple $100 million. They go ahead and they lend this out. Now, of course, it does have higher returns and really attractive returns, but it also comes with risk. When it comes to investing, you have to realize that very early is the more risk that is involved, the more return you can see. And that, of course, has to be mitigated depending on where the money's coming from, what you're investing in. So doing your research before you do any of these, definitely highly advisable. And the final one we look at is investing in high quality index funds. This, of course, like I've said before, when it comes to mutual funds, when it comes to ETFs, they really track market performance. That is why, for me personally, I invest in the S&P 500. That is my core, really core ETF that I have. It's instant diversification. Most of them are passively managed. They have very low fees, like a 0.03. And of course, if you look at 2023, 2024, the S&P 500 funds have done incredibly well. Most of them you can start with $100 or less, which again is kind of crazy. And I really challenge you, when it comes to investing, start with a very small amount. Look at what you're investing in, understand it, understand the platform, the application, whatever it is, whatever brokerage you're using for your investment accounts. Know what you're putting your money into, really going in and doing research. And the bonus one in here is exploring real estate crowdfunding. This is another one that we think when pooling money together, we see Fundrise, we see a lot of REITs, we see a lot of real estate investment projects that are kind of crazy that have low minimums. I think with Fundrise, it's like $100 to get started, but you can go ahead and put money into an investment portfolio, gaining exposure to real estate. So this can be outside of the actual stock market, putting money, and you don't need a significant amount of capital because again, they are crowdfunding this money in its entirety. Now keep in mind, real estate is really a long-term play. For withholding periods, it comes with a lot of risk. So again, doing your research. So to kind of wrap it up, guys, when you start thinking of investment, the journey doesn't have to be a ton of money putting in here. It can be a very rewarding experience. It can also be, for a lot of people, a very good learning experience. High yield savings accounts, they are FDIC insured or NCUA, which is huge. Exploring your ETFs, the robo-advisors, even looking at fractional shares and building that portfolio over time is going to really start with the wealth generation. And it starts by taking the first step. Take $50, put it in an investment account, see exactly what it does, look at the performance, know exactly what you're investing in, and long-term commitment, every dollar you invest is essentially a brighter future for tomorrow. So guys, that's going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.